So we're getting very clear messages from the minutes from Chair Yellen and the latest from Vice Chair Fisher. And they're telling us the following. Yes, we are likely to hike this year, most probably in September, because the weakness in the economy is transitory, and we're not too worried about inflation either on the way up or on the way down. Secondly, don't obsess over the timing of the first rate hike, because what matters is the path. And the path is going to be highly conditional. This is not going to be your hike at each meeting. This is going to be a stop-go hiking measure, a hiking cycle. Third, the terminal point, the equilibrium rate, is likely to be lower than history. Bottom line, Becky, they are telling us this is going to be the loosest tightening in the modern history of central banking. What worries me is that fundamentals at some point have got to validate valuations, that we cannot go on forever with this muddle through and get driven by just cash that's coming back out. At some point, fundamentals have got to validate valuations. And that's the key issue and the key call over the medium term.
What I think is more indicative of is where you want to be sector-wise. You want to be in places like healthcare, financials, technology, that are less concerned in terms of earnings and because of the cash that than would be from the strong dollar.
It's a challenge, especially I think for industrials. It's a very tough situation because, they got to choose between market share and profits. But for tech, I think tech is priced in dollars. I think tech is a beneficiary of basically tight labor markets. So I think you're really okay buying tech here.
We think it may have a little bit more to go, because if you look at the 6 years of this bull market, there have been 12 instances where we've had sell-offs of 5% or greater, the last one having been last September or October. So when you take the combination of the Fed making us a little more certain that there's going to be a rate hike, along with the message that the Dow transports may be saying that the economy isn't as strong as the Fed perhaps might like it, you've got more uncertainty, perhaps more sell-off.
But do you think it's justified to be worried about a potential rate rise? I mean, we know it's going to happen, and if it does happen, it's really only going to be a tiny amount off zero, essentially.
Well, again, it depends on economic performance to a large degree, as has been made clear to us. But in a lot of ways, again, one of the things in this bull market is that markets don't react until right before the event. And a perfect example that we've got Greece facing some deadlines down the road here.